Whether your business is small, medium, large or extra large, there's a retirement solution for every type of business. oldmutualsuperfund.co.za.
Welcome back, and Bronwyn Nielsen is standing by in Cape Town now. With her is Conrad Roos, MD at Standard & Poor's. Bronwyn, good afternoon.
Well, thanks very much, Alicia. Conrad, your thoughts. I know that you've got us on Outlook Watch. Is this good or bad for us from a rating agency perspective, sir?
Well, we have it on a negative outlook, the rating. You will remember we had a downgrade in October last year. That was before the medium-term budget policy statement. And so we lowered the rating from BBB plus to BBB. We kept a negative outlook on the rating. And I think today's budget really is a good reminder that the risks are really stacked on the downside.
They're stacked on the downside. Don't you see this as a pro-business budget across the board?
Look, for me, what I see here is a lot of implementation risk. We look at it really from the rating agency perspective. And as the Minister pointed out, a big unknown, a big uncertainty is obviously the global economy. And this is really...
Let's focus on the global economy for a moment, because there we've got growth forecasts of around about 3.2% for 2013, going to 3.5%. This is for the global economy now. Beyond that, do you think that those are in line with your forecasts on global GDP? Again,
it's perhaps a bit on the rich side compared to our forecast. There are a few big uncertainties. We have seen now how in Europe the crisis has come back all of a sudden with the election outcome in Italy, and so there are many sort of issues out there that could actually be stumbling blocks this year. And we know South Africa is a very open economy. What happens globally has very quickly an impact on South Africa. And this budget really builds on a return to growth in the economy. Last year, what we've just heard today, I guess the fiscal slippage we heard about today with the deficit going to 5.2%, that's somewhat beyond our expectations. That is somewhat disappointing.
What were you expecting?
We would have expected a deficit to come in slightly below 5% of GDP, not slightly above.
You don't take comfort from the fact that we're looking at 3.1% 2015 on the budget deficit as a percentage of GDP?
We would hope that this is not becoming a moving target. I mean, we have seen now how budget outcomes or budget objectives and deficits have been revised over time, and they always had to be revised in the wrong direction from our perspective. So again, I think it's really important that we see this turning point coming. And again, what we've seen probably last year was very much that the automatic stabilizers were working. Government continued spending according to plan. Revenues probably did not come in against the weakness in the economy as planned. That was very much already reflected in our downgrade. But again,
nothing here to get us out of that negative outlook.
Well, obviously one thing that would help would be solid growth in the economy, and as the Minister pointed out, good revenue collections to really keep the budget on track, to engineer basically the turnaround in the debt dynamics. And then one thing we probably even as much or even beyond what we are concerned with regards to the budget is really the situation overall in South Africa with regards to social stability, with regards to what's happening in the labor markets. We cannot really afford again seeing sort of situations like last year, because it would obviously put even more pressure on policymakers to spend the way out of the situation. And again, for that, we don't have the flexibility in the budget.
It did sound throughout the Minister's speech that there is greater engagement with the private sector and government. Did you pick up that theme?
The theme is obviously there, but this is a budget really that has a lot of promises in it, and there's the question really, can everything be delivered? And the theme came up, can everything be delivered with discipline? And so from our perspective, it's really a question about implementation risk. Will we be seeing slippage again as the year passes? And we are in a difficult situation, obviously. There is an election year coming, and that
brave move on that front, on the expenditure cuts rather than raising taxes.
The theme came up, if revenues were to fall short of expectations again, we have to cut spending. Is that really going to happen in the run-up to an election?
Conrad, what's missing for you? We're almost out of time.
What's missing for me? I think really the question is, how can this country return to solid growth in its economy? and create the kind of jobs we need.
So the rating agencies are poised to see us grow. That's the only thing that's going to change our outlook at this stage.
I think at this point, yes. I mean, growth would bring incomes, it would bring job creation, it would bring the revenues to the budget we are looking for, it would help really stabilize the budget, help stabilize the debt dynamics. So a lot really, if not everything, really hinges on growth.
So it's not about the talk, it's all about implementation at the end of the day. Conrad, thanks very much for your time. Alicia, back to you in studio.
Thanks, Bronwyn. Still with me at the desk in Johannesburg is Mohammed Nalla from Nedbank Capital, Tendani Manchamuli, who's consumer economist at Liberty, and Kyle Mandy, head of National Tax Technical at PwC. Kyle, we've had Conrad Royce of S&P very critical, not seeming to be impressed with what's put on the table. A lot of that attention being directed to actual implementation moving forward. Do you think he was being a bit too hard on the finance minister and the South African economy at large?
No, I mean, the bottom line is it does boil down to implementation. As I mentioned, if you are not going to achieve the projected growth, it means your tax revenues are not going to be there. And that's the real risk. The expenditure we know is going to be more or less there, whether they're slightly underspend or slightly overspend, it doesn't really make a difference. The risk is on the tax revenues, which is very much dependent on the growth in the economy. And if that's not achieved, well, we're going to run a higher deficit.
Of course, the view of a credit agency like S&P is critical because you don't want to see South Africa getting another downgrade, because then the cost of your debt starts to escalate materially. We've already got debt sitting at 40%. We've got South Africa, as I alluded to a little earlier, planning to borrow $1.5 billion in international markets moving forward. So we've got to keep all of this in mind, Mohammed.
Absolutely, and I tend to agree. I think the risks are certainly to the downside. The risks are to a disappointment. One of the key risks we at Nedbank have highlighted for this year would be the risk of a further downgrade. Now, S&P maintaining their negative outlook, maintaining their view on South Africa, that's quite a negative indictment on the South African economy. If we see them move one notch below where they are now, that means we're just a notch above sub-investment grade. And I think you'll start seeing, if we move the notch lower, you'll start seeing preemptive positioning from international investors out of our bond market, out of our equity market. And that could be quite devastating, because we are dependent on that foreign flow. As they've intimated, we're dependent on that foreign flow to effectively offset the twin deficits. I mean, that current account deficit north of 6%, that's a huge risk factor. It's not sustainable. In fact, 6% is like the big red flag waving around. And I think all of that feeding into a fairly still negative outlook on South Africa as we go through this year. Implementation risks, he hit the nail on the head with that comment. That
current account deficit often been labelled a ticking time bomb for the South African economy, Tendani. Let's take a look at where money is being spent. 60% of the budget still being directed towards a social spend. I mean, we've seen a substantial growth in social spending over the past decade, and it's seen a threefold increase in the number of people that are now receiving social grants. I mean, how sustainable is this for us to keep funding this part of the South African population, for one, and what kind of dependency or culture of dependency are we creating here?
That lies the problem for me, Alicia. I understand where we come from. We need to reduce inequality. But I think one comment the minister made that came from the president, that every able-bodied South African should be out there getting a job, earning an income, and not depending on government to support that. The problem I have there is he talked about broadening the tax base. This is the tax base that supports the 60% that is talking about on social spending. I don't agree that the tax base has widened substantially in terms of the number of entrants coming into the tax base, because the economy hasn't really grown that much and supported people earning above the minimum tax threshold. It improved because of collection and efficiencies from SARS. So you don't want the tax base supporting.
So we see efficiencies there.
You
we need to see them in other government departments.
You need to see efficiencies in other government departments that support growth going forward. Government's job is not to maintain every citizen in South Africa, is to create an enabling environment for businesses to operate, grow, create jobs, employ as many able-bodied South Africans as possible, not to create a culture of depending on government for that.
Absolutely. Well, we're going to have to hit pause on the conversation for now. We're heading into a short break, but when we come back, we'll be continuing our post-budget analysis and with our panel of guests. So don't go away.